You'll never be a consistently profitable trader if you don't have a proven profitable trading strategy. So in today's video, I'm going to be sharing with you a step-by-step proven profitable trading strategy. This system made me $18,000 this week alone. This video is broken down into 4 simple steps. Step 1 is how to read directional bias. Step 2 is identifying institutional traps. Step 3 is identifying institutional areas of interest. And then step 4 is going to be my exact entry model. And then as a bonus, at the end of the video, I'm going to tie everything we learned together into a step-by-step trade breakdown. So the trade that you're currently looking at right now is the exact trade that we're going to be breaking down at the end of this video. And this is also the exact trade that I called on Friday's live session with my Prosperity School team members. Maybe even something along the lines of, I run on all of this buy side into here and then execute. So before we get into the actual breakdown of the trade itself, let's first go through each phase of price step by step, starting with step 1, which is market structure. How were we able to understand that price should be going lower? So simply put, the first and most important part of any system is first understanding which direction market is going to trade in and why. How we do that is simple market structure. It's identifying the swing points in price, the highs, the lows, the new highs, the new lows, the new highs, the new lows. And as you can quite clearly see, they create a footprint. They create a directional footprint. So in this instance, each high and each low gets continuously lower, obviously indicating bearish price delivery. So at all points in time, when price is bearish, you want to be looking for sells. After each break of structure, your bias is bearish. But unlike most traders who try to sell all the way down here, the key that we want to do is we want to introduce an idea called premium and discount. So what we want to do is we want to take our Fibonacci retracement and we want to pull it just like this from high to low. And that's going to give us the 50%, the 61.8%, and the 786%. These are essentially just percentage retracements of the price leg. So many traders get caught up in selling after the break of structure or selling too early in the pullback. Now, the key here is always waiting for price to pull back into this premium area of price. Once we get in here like this, then we expect that price is going to continue in the same delivery trend, right? Lower prices. So when you see you build a bias, we're bearish, we're getting breaks of structure, price is trading lower. When we get a break of structure, we wait for a retracement back up into the price leg, and then we wait for confirmation, which we'll get into in step 4. Once we get that, then we simply just look at trading lower. That is simple. That is how you use market structure. Now, if we go to the market and first identify market structure, not just theoretically like this, but look at it practically. So in this scenario, you can see that this is where we execute the trade. But before that, we need a directional bias. We need to understand what is the direction of price. So I'm on the 1 hour time frame because we had this very aggressive move after Trump announced his tariffs on Canada, China, and Mexico. So we had a very aggressively bearish euro off the back of that, a bullish dollar. So that give us the structure points. Now, not always are price ranges this large. Sometimes they're larger, sometimes they're smaller. But in this instance, it was from swing high up here to the swing low down here. And that was essentially our market structure. So we had swing high all the way down here to swing low. That was our market structure. We were bearish inside of that. Now, if we go back to the 50-minute time frame, which is the time frame that I primarily use for my market structure, you'll notice on the retracement back up to this swing high, we actually manipulated above this swing high with a very aggressive wick, right? For those of you who already know me, and those of you who don't, I don't consider a wick as a break of structure. The whole idea behind a wick is that it is a liquidation. Price aggressively runs into an area and then aggressively runs out of the area for the purpose of inducing liquidity so that it can move in the opposite direction. So for me, a liquidation is even more confirmation that price will retrace lower. So this was a liquidation that occurred from, again, another fundamental news. It was ISM manufacturing. In this manipulation, price aggressively sold off, and then a few days later, as we come into price, I'm looking at things as still bearish. So if price manipulates, it's still bearish. Until price breaks above this high and closes, it is still bearish. Therefore, I'm still looking for short positions. So my bias is short. Now, here's something that you can do when you're looking at market structure from a very large price range. You have a swing high, you have a swing low. Those are your external price ranges, but it's a very, very large price leg. So what you can do is you can go to internal, and this is what the market would actually look like. You see we go from high to low very aggressively, but then on the way back up, price puts these little swing points in just like this. And so again, a lot of people are looking at this price delivery and they're thinking that price is bullish, when actually price is still bearish. We're just inside of the swing high to the swing low. This is where so many people get lost in market structure. What you can do is when it's such a large range, wait for an internal realignment. Wait for price to stop putting in these higher highs and higher lows internally and wait for a shift. Wait for an old high to get run and then followed by the low that put in the high to get broken. That is an internal change of character. That is your confirmation that now we're getting ready to go lower and now you can execute to go short. So if we come back to the price delivery, right, on the 15-minute time frame, and I see that the high is up here, the low is down here, on the way back up to these highs, you can see that price is putting in these highs, lows, higher high, higher low, higher high, higher low, right? It's putting in this bullish structure that a lot of people are looking at to be bullish. And then what happens? We put in high in here or equal highs, high in here, we pull back low, new high, new low, new high, new low, liquidation, and then we shift off the back of the liquidation. But the key sign for me is when we broke this swing low down here, right? This internal swing, because when this low gets broken, it's a very significant structural level. So now I don't need to focus on the whole external price range. I can now use my structural levels from basically this high to this low, and then tell myself that we're bearish inside of this level because that's what it is. The internal is realigning, the internal is getting ready to go lower. So I can filter it and use this. And so now this becomes my primary focus, my primary lens coming into this specific day of swing high to swing low. And so now we're inside of another range. And again, what are we? We're bearish inside of this range. So if we pull out our fib, like we just spoke about, and we draw low to high in this fib level, you can see that the 50% is here. So the first things first is we only want to be shorting when price gets into this 50% for the most part. That leads us into step number 2. How do you filter on where it is that you want to sell from? And the way we do that is with liquidity. Now, simply put, liquidity refers to money. That's it. It's where is the money? Where are the buy orders? Where are the sell orders? Where are the stop losses? You need to put yourself into the shoes and understand where is all of the liquidity in the market? Where are other types of traders selling from? Other types of traders buying from? And where do they have their stop losses? If you can understand that, you will understand where the liquidity is. And the market operates like a magnet to metal, where the market runs into liquidity, into more liquidity, into more liquidity, into more liquidity. That is the primary purpose of the market. So when you can identify these pockets and you can then align it with market structure, when you see an obvious pocket of liquidity with market structure, you have what looks to be appearing as an A+ setup. And that is exactly what this setup was. So for me, if we come in here, key areas of liquidity that you should always look out for. Number 1, trend lines. When you see these types of trend lines forming, you have the one touch, a little bit of a breakthrough, and then pull back in, a wick, and then pull back in, right? Price is continuously respecting this trend line. That is obvious level of liquidity. So that's one area of liquidity. A second area of liquidity is old Asia highs. One of the biggest pockets of liquidity is this Asia high and Asia low session. So that is always a massive green flag if you can wait for a run on Asia into an area of interest to go lower. The second, again, equal highs. Right here we have perfect equal highs. Why are they areas of liquidity? Because what are people looking at? People are looking at trend lines. They're looking at equal highs. The people that got in Asia session, they put their stops in a safe level, which is always above Asia or below Asia. And then another one, weak highs. What is it that makes a weak high, may you ask? A weak high is created when a high doesn't break a low. So here we have a low, and then this low puts in this high. Now, the responsibility of the sellers at this price point of this high is to break this low. Now, when you see that this high begins to go and run on its attempts to go and break the low, and then price starts reversing, well, this high becomes weak because it's failed to do its job. So all of the sellers that were getting involved here are now being over-dominated by buyers. So guess what? All of the sellers that are getting involved in here, where are their stop losses? Their stop losses are here, above this high. But if they don't have the momentum to outweigh the buyers, and they can't continue pushing price down, the next obvious area of liquidity is going to be at the highs. So there you have it. There is so much stacked liquidity in this area. We have trendline liquidity, we have equal highs, we have Asia high, we have old highs. All of this liquidity is set up to be manipulated. And then guess what happens? When that liquidity gets taken, when everybody who in here is selling, well, then you have the other side of the market. When the equal highs get broken, or when the structure gets broken, or when the Asia high gets broken, or when the trend line gets broken, now all of a sudden, everyone is looking to buy. You have the trend line breakers. You have the resistance that turns to support. You have the breakout traders. Now all of those guys step into the market, and then they become the new liquidity because they then put their stop losses lower in price. And so now the market, after taking out all of one side, is going to go and take out all the other side. But it's only when you know and understand that principle that you can cut out all the noise of what everyone else is doing and focus on doing the opposite. If 90% of traders fail, then you understand what 90% of traders do, and you do the opposite, by very definition, you will be consistently profitable. So how do we then take that into more alignment? Well, step one is market structure. So we have our bearish alignment. We're bearish, so we're looking for sells. That's the first principle we have to solve for. Step two, liquidity. Let me identify all the liquidity so that I don't get trapped in trying to sell from an area where there is liquidity. So I need to identify it and then wait for it all to be taken. Step three is institutional areas of interest. The way we do that is finding old fair value gaps and old order blocks. So let's go and take a look at what that looks like. Now, quick segment for those who maybe don't know what an order block is or don't know what a fair value gap is, very, very quickly. A fair value gap is a 3-candle formation when the low of candle 1 and the high of candle 3 don't meet. So if we zoom into this specific area right here, right, and we mark out the low of candle 1 to the high of candle 3, you see how they don't touch and they create this gap right there? That is a fair value gap. That is an imbalanced price range. And the objective of price is to be balanced. It's to create fair value. So why these areas are important is because oftentimes with a statistical probability, price will trade back into those gaps. Now, disclaimer, just because you notice a fair value gap doesn't mean it means anything. The same with order blocks. So many smart money traders fail, and the reason they fail is because they don't trade contextual to price. They think that I see an order block, therefore I'm going to sell or buy from that level. I see a fair value gap, therefore I'm going to sell or buy from that level. It's not that simple. They are just a tool, but they should be part of a system. For order blocks, an order block is also the same thing. If you look at a fair value gap, every fair value gap will be paired with an order block. The order block is the manipulation that happens before. So if you look at this, you can see that we're ranging, and we get aggressive bullish move that takes out old highs, and then we get the aggressive sell-off. So it is basically identifying where did the momentum start coming from. So the aggressive selling momentum starts from this candle. And if you take the high and you map it across, that becomes an order block. So you have order blocks and fair value gaps. That is what we need to identify as we look for a trading setup. So now if I look inside of my price action, I have the task of identifying areas of interest that are above this high, that are below this low. It's that simple. And so how do you do it? Well, the first thing first is we see that there's a fair value gap here. Okay, cool. There's an order block that sits here. Okay. Is there anything else? No fair value gaps in here. Let's zoom in, get closer detail. You can see that there's a very, very small fair value gap in here, right? Something that we can still look at. Very, very small fair value gaps in here, right? That we can take a look at. And yeah, that's pretty much it. So there are these multiple areas of interest in which I would expect price to react from. Now here's the key. You don't just sell from those levels. You wait for an entry model, which leads me directly onto step 4, our entry model. You've got your directional bias. You know which way that market is going. You have your liquidity. You know where to avoid and what you need to wait to happen before you can enter. You have your areas of interest, areas of price that you expect that selling momentum will come back into if it gets hit in there. But we're not just going to sell from every order block or fair value gap. That would make us like the rest of everybody else. What we want to do is we want to use confirmation from those levels to tell us whether this level is going to hold or not. I mean, how many times do you see order blocks that just get traded straight through, or fair value gaps that get traded just straight through? It's not good enough to know where they are. We have to be able to confirm them. And here's how we do that. So let's say we're bearish, which we are. We have a high, we have a low, we have a lower low. We have, let's say, a fair value gap in here, and let's say an order block in here. The key to consistency is lower time frame confirmation. If this is our 15-minute high and our 15-minute low, when we get into this level, we want to zoom in to the 1-minute time frame and wait for a very specific market structure shift or change of character. What does that look like? As price comes higher in here, the 1-minute time frame is going to be bullish. So as the 15 minutes pulling back like this, the 1-minute time frame is going to be bullish. And then it gets into that level, it's still bullish until it's not. When it shifts, when it goes from being bullish and then we get into the level and then we shift bearish, that is your confirmation. That is your trigger to go short. That's the confirmation that this area obviously has momentum coming from it. Because the order book, there's buyers are in control, buyers are in control, buyers are in control, and then all of a sudden buyers can't protect the old level, and then sellers become in control, which simply means there are more sellers than there are buyers. There is more liquidity in the sells than there are in the buys, thus price will go down. It's simple economics of supply and demand. So once you get a break of structure, followed by a change of character like this, from an area of institutional order flow that is bearish in alignment with trend, that is your confirmation to go short. Once you do that, you want to take your position, take an order block or fair value gap or whatever on the lower time frame, and then you want to target a minimum of 1 to 5 risk to reward. So let's go and see how all of that now comes together to create the step-by-step breakdown of this exact trade that we live called with the members ahead of time. This is the same price action. This is where we take the trade. What we'll do is we'll just go back in time just as London session is opening as I start my trading session and take a look at how things play out. Just before and relative to the clip that I showed you at the beginning, this is where we were when we gave the call out to the members to say, if we get a run on here, followed by a lower time frame shift, everything I've just taught you, and then we go lower like this and execute from this level, that is what I'll be looking for. How does that all come together and unfold? Well, we've already broke down structure. So we have swing high, swing low, price comes up, manipulates the high, doesn't count as a break. Cool. Large price range, so we're going to go to internal. So we go to internal, we get the internal confirmation or break of structure or change of character in here, right? So we're going to label that as internal change of character. So now we have a new swing high, a new swing low, and that's our structural range. This is our high, this is our low, and we want to trade inside of that. Step 2, identification of liquidity. We have the obvious trend lines that's coming in here, even if you draw it all the way up to here. This is all one trend line, so we're going to mark it out as liquidity. We have Asia session high, which is liquidity. We have equal highs in here, which is liquidity. And we have an old weak high in here, which is liquidity. So this is where all the liquidity sits. So once we've purged this liquidity, we're good to go. But where are we shorting from? That's where our institutional areas of interest come in. So the overall area we have is this whole level with a fair value gap and order block combined across here. And there are some other levels up in here, which for the relevance of where we actually get executed isn't important. So I wait for price to run into an area. If price doesn't do what I need it to do, I don't even think about trying to take a trade. I wait for price to meet my plan every single time. If we play price out, London session opens, we have this aggressive momentum. We run the first pocket of liquidity, we run the second pocket of liquidity. We've now broken out of the trend line. So many of these traders are being taken out of the market. Then eventually we come into our area of interest, right? We come into this area. So when this happens, I drop down to the 1 minute time frame. I zoom in, and guess what? As price is coming up into this 15-minute area, because if we zoom out, it's still the 15-minute, right? Nothing really changes. It's still the swing high to the swing low. We're coming up. The 1 minute time frame is bullish. We don't want to be selling when the immediate order flow is bullish. We want to wait for a change of character. So you can see all these swing points in here. If we go to the most recent and relevant swing point, right, one that meets the 3 candle pullback criteria, you can see we have the high comes in here, 2 candles, no, 2 candles, no, 3 candles, yes. So we have a high and a low. So this is the low that is currently in control of price. This is the low that I need to see get broken to be confirmed that price is going to go lower. So it's just a waiting game. If it breaks, it breaks. If it doesn't, I don't trade. And then eventually it breaks. That becomes my trigger. That is my confirmation that now it's ready to short. This zone that I marked out is what I thought it was, right? That's the confirmation. So we have our change of character. Now I need to find an area where I can execute. So what I usually do is go to a 5-minute or 15-minute and find an order block or a fair value gap. You can see on this 5-minute time frame, there is no order block and there is no fair value gap. It's all mitigated. There's no gaps, so I go to 15-minute. When I get to the 15-minute, price looks like this. We have an obvious order block and we have an obvious fair value gap. So I can take my entry on either one of them that I decide. In this scenario, we go with fair value gap. There are a couple of reasons why we choose fair value gap instead of the order block in here, but we use the fair value gap, and then we just want to target 1 to 5. I'm also very cognizant that today is NFP, so I don't want to hold this trade for long. So usually I would be looking at taking out the swing low on the M15 and holding this position longer. But NFP is coming out and I don't want to be in the market when that occurs. So I just want to get in and get out as fast as I can. If my 1 to 5 doesn't happen before NFP happens, I'm going to close the trade. In this case, we'll see how it plays out. So here we are, 5-minute time frame. You can see our entry is set, and then pretty quickly price tags us in and we have a really nice reaction. Price begins moving to the downside, really aggressive price delivery. We range a little bit. New York session opens. I'm getting ready to close the position. The close hits 5R and that is the trade concluded. Now, if you want to be a consistently profitable trader and get more in-depth breakdowns just like the one you've had today, plus much, much more, you can book a call with the link below to speak to one of our trading advisors to see whether or not we can help you become profitable faster.